Top business stories live from Sky News. Serious water pollution incidents were up by 60% last year in England, with 3 companies responsible for the majority. The chairman of the Federal Reserve, Jerome Powell, remains in President Trump's sights following a lack of interest rate cuts. Plus, Netflix raises its revenue forecast after net profits soar by 45% in the second quarter. Very good morning to you. Business Live with me, Gareth Barlow. President Trump has said he hasn't ruled out firing the Federal Reserve Chairman Jerome Powell following months of frustration due to his refusal to cut interest rates. The Fed has been cautious about interest rates as it assesses the impact of Trump's tariffs on inflation. Well, joining us now, Fiona Cincotta, Senior Market Analyst at City Index. Good to have you with us. So, what's the likelihood? Powell staying in, or will he be forced out?
You know, I think the Federal Reserve needs to remain independent. So, I mean, Trump is playing with fire when he's trying to meddle with the central bank. There have been several CEOs this week on Wall Street from the big banks, from Goldman Sachs, from Bank of America, most notably from Jamie Dimon, the CEO of JP Morgan, who does have quite a lot of sway with President Trump, saying that Trump should leave the Federal Reserve alone. So although Powell hasn't been cutting interest rates at the pace that Trump wants, it would be very dangerous and really raise questions about credibility if Trump does remove Powell.
Like you say, playing with fire, big banking voices signalling their discomfort with this. What would the markets do? What signals would it send to the markets if he does take that pretty remarkable step?
Yeah, so I think we just got a little bit of a taste of that this week when there was that media circus over Trump suggested, rumours saying that Trump may fire Powell. And we saw the stock market wobble quite significantly, of sort of big swings. We saw the US dollar come lower. And I think, that's what we would expect to see, a big market reaction, a lot of volatility. But I don't think Trump even actually needs to fire Powell. I think even if Trump sets up his nomination to replace Powell significantly earlier than expected or before the end of Powell's term, which is in May next year, then that in itself could have implications because the market would start to assume that the Fed would cut rates more aggressively in the coming year. So, it doesn't even need to be a firing for it to have a market impact.
And of course, we need to remember that he was temporarily surprised that he was the one that appointed Powell, and he said it was Biden that was responsible for it. You talk about the stock market wobbling, big market reactions. Are we seeing any outflows of capital from the US already? Are we seeing outflows to Europe or to Asia?
Look, it's interesting because, if we look about where the US stock market is, it is trading at all-time highs, especially thanks to the tech element of the NASDAQ and the S&P 500. But I think part of that is also actually because of the US dollar weakness that we're seeing. So US dollar weakness does tend to be or keep US equities buoyant. So I think we're actually seeing this a lot more in the FX market than we are necessarily in the stock market right now. And we could continue to see flows from the US dollar into other currencies as the market just remains a little bit uncertain with Trump's tariff turmoil and just the outlook more broadly for the US economy.
And just very briefly, Fiona, the potential successors, if they were to come, what would their take on interest rates be?
I think what we'd probably be looking at here is a replacement who is slightly more dovish, so more in favour of cutting interest rates in the US more aggressively. So, that's why I say even their nomination could see the market actually repricing its expectations for what the Federal Reserve will do come May next year. And we know the markets do tend to work a little bit ahead of themselves. So that's why we could see a reaction happening, even if that nomination happens in October or November.
City Market Analyst at City Index, Fiona Cincotta. Good to have you with us as ever. Thank you.
Thank you.
Let's bring you up to speed on some of the day's other stories. The streaming giant Netflix has raised its revenue forecast for the rest of the year after its net income rose 45% in the second quarter. Growth in advertising and also subscribers, plus the weakening, as we've just been hearing, of the US dollar, which suffered its worst first half in 50 years, means the company's overseas earnings were worth more. Huge international hits such as Squid Game and the British crime drama Adolescence are also credited with driving that boost. Mid-sized businesses are growing at their fastest rate since Labour was elected last July. That's according to new data from NatWest. Mid-market service providers saw their strongest rate of growth in 15 months in June. That's as UK bosses shake off cost increases in taxes and utility bills. The most powerful supercomputer in the UK is now operational. The computer, called Isambard AI and located in Bristol, will become part of the UK's public AI computing capacity, in addition to a machine in Cambridge called Dawn. The plan is to use them for tasks like reducing NHS waiting lists and developing new tools to combat climate change. Of course, scan that QR code on the screen right now. You can take yourselves to the Money Blog. Plenty more stories on the Sky News app. Sky News can exclusively reveal that accountants advising people who entered into a tax avoidance scheme, which was later found to be illegal by HMRC, were being paid a commission. Chartered accountants had been advising their clients to enter salary loan agreements run by companies that were paying them to do so, a scheme that later led to workers being hit with giant tax bills, sometimes hundreds of thousands of pounds. Well, joining us now is Arjun Kumar, tax specialist and co-founder of the online platform Tax. Good to have you with us. How on earth do we end up in a situation where what's being advised and what's being legal are very, very different things?
Thanks for having us on. And it's a key topic at the moment, especially with the recent outline of the loan charge scandal. And it's kind of one of those situations where what's being advised is in a grey area. And I think that's where accountants, there's a bit of a conflict of interest with the commission schemes, and accountants in general, they charge on an hourly basis. So it's quite lucrative to be able to go for the commission option, the commission approach. And these schemes were presented as being legal. However, it is a grey area that HMRC are now clamping down a lot more on, tax avoidance schemes.
Always important to differentiate tax avoidance with tax evasion. Tax avoidance is legal, but like you say, it's a grey area. And on that basis, is it not fair to assume that people engaging in it or considering it should expect a fair bit of scrutiny from HMRC?
No, of course. And I think that's where there is always a bit of confusion. Even though it might be legal, you're not using the system in the way that it was designed or intended to be used, right? It's important for individuals across the UK, and we're certainly a big supporter of becoming as tax efficient as possible. Maximise your tax efficiency wherever you can, and don't pay HMRC more than £1 if you don't need to. But at the same time, tax avoidance is using the system in a way that it's not intended to be used. And those are the loopholes that HMRC now are trying to close, and have the power from the anti-avoidance measures that they have to really crack down on it. So it's important for individuals to know that even though things might be marketed as legal, to kind of check with their accountant, check with their advisors, and make sure that it's if a scheme is too good to be true, I mean, it probably is.
Is there an argument, Arjun, that the high tax burden here in the UK could be pushing some people to try and find these loopholes, and potentially a way of, I don't know, reducing the loopholes is to maybe reduce the tax burden?
It's true. I think there's a theory in the tax world called the Laffer curve. The higher the tax burden actually means there's potentially less tax actually collected. And I've seen a lot of these kind of advertising online nowadays on how you can reduce your tax by setting up in Dubai, this, that, and the other, right? And these are schemes that may not necessarily work. You're not actually kind of doing things the right way. Your tax residency might still be in the UK. So I think we are seeing more of this as there is more media scrutiny on the high tax rates in the UK, and it's potentially is moving people towards looking at schemes that aren't necessarily the right way of doing things.
So what do you do? Do you simplify, or do you reform, or do you do both when it comes to taxation?
In my opinion, I think we should be simplifying. I think tax at the moment can be very complicated for individuals, and that's where it's important for people as well to get the right tax support when they need it. And then at the same time, the tax system itself just needs to be a bit more simple for the everyday person, right? It should be easy to understand exactly what you can and can't do. And loopholes like the loan charge scheme should have been caught and stopped at the start.
Arjun Kumar, tax specialist, co-founder of the online platform Tax. Good to have you with us. Thanks for sharing your thoughts. Time now, as ever, to take a look at the markets. Joining us is Joshua Mahoney, Chief Markets Analyst for Scope Markets. Good to have you with us. Thank you, as ever, for sharing your time. Well, let's start with the FTSE 100 and kind of FTSE 250. What's the driving strength behind the stocks at the moment? Because they're doing pretty well.
Yeah, it's an interesting one. I guess the movements that we've seen for UK stocks over the course of this week really do prove that the stock market is not the economy, because we have seen some significant questions arise, most notably with the upside move for the unemployment rate, the move higher in terms of inflation. Currently, the UK is in a position where we've got negative growth for 2 consecutive months. So you would think that would push sentiment lower for equity markets. That's not necessarily the case. We've seen the FTSE on the rise, and actually the FTSE 250, which is more domestically focused, outperforming the FTSE 100. Different pockets of strength. We've seen Burberry doing well today. We've also seen strength for the likes of the oil and gas names, the mining names. There is increased confidence that we could see some sort of agreements coming to the fore between the likes of the US and China, certainly with the fact that the US are now going to allow NVIDIA to export their H20 chips to China. That sort of points towards some deals potentially going on behind the scenes. So, yeah, as things stand, the FTSE 100 and FTSE 250 holding up well today.
You talk about Trump and China and international markets. Obviously, the UK kind of secured that deal, although whether you call it a trade deal, I guess, is up for a bit of a debate. But how has that insulated or otherwise the UK? Because we've seen Trump writing these letters again to other nations about tariffs. Has that helped just bring a bit of certainty to London markets, do you think?
On certain days, it seems that way. I mean, you can certainly see that the likes of, say, the DAX over in Germany has done incredibly well despite the headwinds that it faces in terms of the potential breakdown in relations with a key trade partner in the US. So for the most part, generally, the FTSE 100 isn't necessarily that haven, but there are certain days and periods where you'll see it outperforming the rest of the pack. And it has held up very well, despite, like I said, some of the concerns that there are around the UK economy, with many probably feeling that if they want to avoid the uncertainty and the repercussions of, on this occasion, the 1st of August deadline, but that may get pushed, they've got to head into something that's a little bit more stable. And the FTSE 100 has been that.
As the old saying goes, if America sneezes, the rest of the world catches a cold. Let's just stick with Donald Trump for a few moments, because if he is to make changes at the Fed, if Powell is to go, A, how will the markets react to that? And B, what do you think they'll be looking for in a replacement?
Well, we've already seen a very short snippet of exactly how markets might react to that. Earlier in the week, we heard White House sources saying that Trump was on the cusp of sacking Jay Powell. We saw weakness in terms of equities, weakness for the US dollar, higher treasury yields, so borrowing costs moved higher. The price of gold moved towards the upside. So we kind of have an idea of what might happen if that's exactly what does come to pass. I think it's going to be difficult for him to replace Jay Powell. And the question mark really from here onwards will be, who does he replace him with? And also, when will that happen? Is it going to happen way down the line? Does he do it now? And therefore, essentially, Jay Powell's got someone sort of looking over his shoulder and saying, well, I would have cut rates on this occasion or not. Arguably, in my mind, I think it's probably from a market perspective, even if he does seek to replace him early, or at least put in the so-called shadow chair earlier, I think someone from the FOMC, and certainly today we've seen Fed member Waller coming out saying he would cut rates in 2 weeks' time. If it's someone that's a so-called steady hand rather than someone already in the administration, that in my mind means that there will be a perception that the Fed will, to some extent, still keep their independence.
And just finally, if Donald Trump is to be accused of being fickle, then the crypto markets take that to a whole nother level. But talk to me about that, because some kind of good news relatively across the board.
Yeah, I mean, look, we've hit 122,000 on the price of Bitcoin. It's pulling back a little bit today. We've seen the passing of the first major crypto regulation in the Genius Act, and that provides a safer framework, some would say, in terms of businesses operating within that sphere, particularly moving into the stablecoin area. And stablecoins, notably, many of them have to be backed one for one for the US dollar. So this is the case of the US trying to make sure that the dollar is front and center when it comes to the future of digital currencies.
Joshua Mahoney joining us live from central London. Really good to have you with us. Thank you. Still to come here on Business Live. The Bank of England's Monetary Policy Committee weighing up a cooling job market against hotter than expected inflation. We'll look at where interest rates might be headed next.
Our app gives you the very best of Sky News wherever you are. Breaking news, videos and analysis.
Evidence of the crisis.
Podcasts, watching us live.
Live here from Washington.
Wherever you get your podcast.
All in one place. And all at just the touch of a screen. The Sky News app. Get the full story first.
This is the game changer seat. Look, it even comes with binoculars. Flying units fly better. Thank you.
Breaking news to bring you now from the United States. Donald Trump posting and talking about interest rates. He says we deserve to be at 1%. Talking about the Federal Reserve, he says in many ways the board is equally to blame. I think sharing the blame between the board and Jerome Powell. Lots of focus on whether he'll stay in his role. Of course, appointed by the president, although he forgot that. He thought he was appointed by Joe Biden. Let's discuss all of this with George Lagarius, chief economist at Forvis Mazars, joining us live from Athens. Good to have you with us. Donald Trump says that the United States deserves to be at 1%. Remarkable.
Yeah, so U.S. inflation is running at 3.7%. It's at 2.7%. It's about 50% higher and a little bit less than the Fed's mark. It's heating up. That's the important thing. We've seen it in all PMIs. From an economic perspective, this doesn't necessarily seem to make much sense. Having said that, it depends what you prioritize. If you prioritize growth, then by all means, take rates down to zero and wait to see what happens with inflation. Okay, if you prioritize price stability and macroeconomic stability, then keeping the rates at very near your nominal rate of growth, which is your real rate of growth plus your inflation, makes a lot more sense. So it's a matter of priorities, really.
Do you think Trump's doing what he classically does? You know, think of like NATO, for example. He goes, I'm going to pull out of NATO, and then all the European countries go, oh, we're going to put a load of money in. He decides to stay. Is he doing the same here with interest rates and going, I want 1%, and then actually settling for something, like you say, somewhere in the middle?
Here is because I just heard this tweet as you guys were talking about it, so here is my take on it. There are two notable Trump appointees on the Fed board that have been vocal about slashing rates as early as July, and they're considered contenders for Powell's position. So basically, he's just reaching out to the board and asks them to pressure Powell more. This is what I'm listening from this tweet.
Let's just turn our attention to the UK if we can. The Bank of England has an interest rate decision of its own to make, I think on the 7th, if memory serves me correctly. And it's got challenges ahead, doesn't it? Because you've got the challenge of a kind of weakening, slowing, stagnating jobs market, unemployment rising slightly this week. And then you've also got the fact that there was, well, an unexpected uptick in interest rates. What does the bank do going forwards? What's its decision going to be in the early part of next week?
Okay, so I think that we will see 2 rate cuts by the end of the year. And I think that the calculus in the UK's case will probably shift towards growth. Okay, so stagflation, because we're in a stagflationary situation. Let's not mince words about it. But stagflation isn't meant to last. Either inflation begins to pick up or growth at some point drops a lot and brings inflation down with it. And it's more often the latter than the former. So, you know, we see unemployment ticking up. We see economic activity down. It doesn't make much sense for inflation to persist for much longer. So, yeah, maybe the central bank will want to see some evidence of that happening. But I do think now their attention is shifting towards making sure that growth doesn't crash either.
Of course, I got ahead of myself. It's not early August next week. We've got to wait a couple more weeks before that decision. Of course, the other key thing is not just what decision the Monetary Policy Committee makes, but also the split of the voting members. How close to a consensus do you think we'll get when it comes? You
mean the rate cut? Or the decision? Sorry, I wasn't just sure of the question. But I think for the next... I think that for the next meeting, I don't think we'll get a rate cut right at the next meeting. Or at least, you know, it's a sort of 50-50 thing. So we could see a split if that's where things are going. To see a consensus, I would wait until October. Okay, I think the data will be much more conclusive then.
George, really good to have you with us, joining us live from Athens. Appreciate your time. Have a good afternoon. New data shows the number of serious water pollution incidents in England rose by 60% last year. 3 companies responsible for the bulk, the Environment Agency, said that more than 80% of the 75 instances were responsibility of Thames Water, Southern Water and Yorkshire Water. Let's bring in our Science and Technology editor, Tom Clark. Failings at water companies, it feels like Groundhog Day.
I mean, where do we even begin? Despite, you know, more than a decade of upset and pressure on water companies and pollution incidents, the situation is getting worse, not better. And the water companies will perhaps point out it was a wet year, 2024, the one we're comparing the previous year to, that 60% increase. And it was, and more water puts more pressure on sewage systems, more likely to lead to these overflows. But it's no excuse, because this is the 3rd consecutive annual increase in pollution incidents there's been, according to the Environment Agency data, and overall a 47% increase since 2016, when this monitoring work began. So there isn't really an excuse, and it leaves people with the conclusion, I think, that we've known for a long time, which is that the water companies were so grossly mismanaged in terms of how they stack themselves with debt to pay dividends to their shareholders, while, you know, I think the EA defines today as persistent underinvestment and poor asset maintenance. And this is the response, and it's going to take a lot of money and time to fix it.
And then you have this vicious cycle where you have the history you've described, the lack of investment, the debt, companies like Thames Water really struggling financially, then these instances of pollution, then the fines, which then cripple them more financially.
And they can't afford to pay, so they're going to have to go into the special measures thing. And I think it's probably coming time to be... to be quite honest here, we're stuck between a rock and a hard place. We take them back into national ownership, the costs of doing the necessary work fall to the taxpayer or they fall to the bill payer. Either way, bills are going up. According to the Public Accounts Committee, which has been looking into this and reports also today, you know, bills are going up by the greatest amount they have in 20 years under this latest cycle to Ofwat. And while we can look with outrage at the water companies, they just do what corporations do and try and make the most amount of money for themselves. The real failure, I think, here most people acknowledge, and the Public Accounts Committee certainly draw that conclusion, is with the regulation. Ofwat has failed to do its job. It's obviously trying very hard to make up for that now, but has over a long time failed to regulate efficiently. Environment Agency hasn't had the capacity to do the inspection work and the enforcement work it does. It's now overloaded with enforcements. One criminal prosecution is taking 4 years to go through. And ultimately, DEFRA, which has oversight of those two bodies, is in the frame too. And the Public Accounts Committee singles them out for blame specifically in their report today.
Just very quickly, though, if the boss of Thames Water's here, he'd point to the £9.5 billion investment they plan to make in sewage refurbs and investment over the next 5 years. So the consumers, the public, the society shouldn't expect to fix anytime soon. Not at all.
And that will only, as I understand it, the money that's been pledged by water companies in terms of investments so far, I think it comes up to about 12 billion across the board. We'll only fix 44% of those storm overflows. It's going to take a long time to fix, and we're going to have to carry on paying for it.
Tom, really good to have you with us. That's it from Business Live at the moment. Sam Washington back at 4:30.